Hi everyone. In this video I'm going to be talking about Commodities by Jim Rogers. How anyone can invest profitably in the world's best market. So why? Why should you care about Jim Rogers and why commodities? First of all, Jim Rogers is one of the best commodity investors in the world. He has a long track record. He had he has written multiple books on the subject. He worked with Soros. He's the expert. So why should you care about commodities? There are two reasons. First is leverage. In typicals with stocks, typically you get twice leverage, but with commodities you can go up to 20 times. And the second point is diversification. It's a great way to diversify your portfolio, as we'll discuss later on in this video that stocks and commodities are roughly inversely correlated. So this will be the agenda of my talk. I'll talk about being contrarian, and then I'll give you the recipe for success. We'll talk a little bit about supply and demand and how we should think about it, and I'll mention a few data sources that Jim Rogers like to use, and lastly we'll take a look at stocks versus commodities. So let's start with being contrarian. The first thing you should be aware of is the crowd. Where is the crowd and where you're standing with respect to the crowd. Um, Typically, you want to be contrarian because you cannot make outsized profits when you're with the crowd. But it's not just about being contrarian. So you don't be contrarian just for the sake of being contrarian. You have to be contrarian and right at the same time. So uh, be mindful of that. There are two phrases that, I mean, reading through this book and just watching Jim Rogers, two phrases that he likes to use. For example, he'll say buying the dips, he'll talk about reversal to the mean. And I think uh, these are opposite of momentum. In a momentum type discussion, you say, okay, if something is going up, it'll keep going up. But he thinks the other way. It's the opposite. It's reversal to the mean. If something has been very low, then eventually you'll go back to its mean. And this reversal to the mean is not really symmetric. And what do I mean by that? It means that when things are too expensive, that's a little bit more tricky. But if something is very cheap, then you can buy the dip. Uh, Here's what Jim Rogers says. He says, "I don't like to sell something short unless it's unbelievably expensive, and I mean unbelievably. I've shorted lots of things in my life that were expensive, only to see them get more expensive." The reason for this is when people if there's a bubble on something, the prices can go extremely high. And the reason for this is that there is no resemblance of reality. People are not valuing things correctly at that point. They're not applying discounted cash flows to value things, to price things. At that point, they're just investing emotionally without looking at any real value. So that's why you'll never know how high it can get. It's just depends on how crazy people are. Alright, so let's talk about the recipe for success. This is what Jim Rogers tells us. There are 4 steps to it. First, you start with doing your homework. You have to look at the data, and we'll discuss some of the data sources soon. And you look at the data to identify a supply and demand imbalance. And you sometimes you can get away without looking at the data. If there's an extraordinary event, and let me give an example. During COVID, the oil prices were very low, especially at the beginning of the COVID, because people were stuck in their homes and they're not driving, so they're not buying gasoline. and the prices were very low. And eventually they figured out the vaccine, and the vaccine was successful. The moment I read this article about the vaccines being very effective, I went out and bought some futures on oil, and I made a decent profit. So this is one such example where I didn't even have to look at the supply and demand picture. Just the 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 extraordinary event was sufficient enough to inform my trade. But that's not always the case, and even so, you should be looking at the data uh, and identify the supply-demand imbalance. The third step is to make your move. Now, this sounds very simple, but it's not as simple as you think. This is about getting the exposure to that commodity. How are you getting that exposure? Are you, for example, you might get futures. You might invest in stocks that are commodity producers. They're producing the commodity that you're interested in. You might buy an ETF that somehow has an exposure to that commodity. So there are several different ways to play this. Which one is the best way? Well, overall, I'll just give just a basic answer to this. Ideally, futures is the best way. Get your exposure directly instead of these adding these extra steps and getting your exposure through a derivative. Just get your exposure directly with a futures contract. And the last step is get lucky. This sounds funny, but the idea is to, once you're contrarian and you're ahead of the crowd comes to you. In that example, I've talked about the COVID and oil prices. I was ahead of the crowd, and the crowd came to me, and I was able to make the profit that way. So being ahead of the crowd and getting lucky because you were prepared, that's the recipe for success. All right, so let's think about supply and demand a little bit. I just want to emphasize this sentence here. Comparing the rate of change in demand to the rate of change in supply. I think this is the most important sentence here. This is what you should be looking at when you're looking at supply and demand picture. But let's dive a little bit deeper and let's discuss supply and demand separately. So in supply, what should we be looking at? So we should be looking at worldwide production, any existing inventories, reserves, how expensive it is to develop and produce this commodity. If it's not worth it, why would you do it, right? As a commodity producer, why would you do it? And so what is the potential supply over the next 10 years? So this is a forward-looking. Ideally, you should be looking at the current picture, and also you should be looking at a forward-looking assessment. And what are some new sources and expansions? This is tricky because it will take a long time. We read these articles, I'm sure you've encountered an article like this. They find a new a gold mine, they find a new oil source. There are different versions of this. But any of these are typically, it would take years to get it into production and to the markets. So you have to be mindful of this. Just as you're reading this article, doesn't mean that this will immediately affect the prices. It will take years to see the effect, if any. Lastly, extraordinary events. I just gave an example about COVID and oil prices. Right now we're going through another extraordinary event with the Russia-Ukraine conflict. Russia is one of the top natural gas producers in the world, so natural gas prices have been going up significantly. Ukraine is one of the top wheat producers in the world. Wheat prices have been going up significantly. So these extraordinary events definitely impact commodity markets. Let's talk about demand. What should we be looking at in terms of demand? Well, demand is a little simpler. What is this commodity being used for? Is this use going to continue? and can it be replaced by something else? These are few things you should consider when you're looking at the supply and demand picture. Okay, well, what are some data sources that you can use to look at the supply and demand picture? I'll emphasize. So what you're seeing in the picture here, this is CRB Commodity Yearbook. Jim Rogers says this is the Bible of commodity traders. This is an annual, published annually. This has been going on for a long time. Jim Rogers have been buying this commodity yearbook since 1970s. Every year he says, I buy this book. So this is really valuable. Very recently, I think it has been bought by the company Bar Chart. So check it out if you're interested. For minerals, Jim Rogers recommends you do U.S. Geological Survey. For metals, American Bureau of Metal Statistics or American Metal Market. These are some of the data sources that Jim Rogers like to use. All right, let's talk about stocks versus commodities. I want to classify every company into these three buckets. I'll start from the leftmost, which is independent. What do I mean by independent? These are companies that have nothing to do with commodities. It could be a software company. They don't care about commodities, most of them at least. It could be service-based business, so they don't have an exposure to commodities. The middle group is the one that has the most exposure. I classify them as consumers. You can say manufacturers. These are the companies that are using the raw materials, the commodities, adding some value to it and selling it to their customers. And this is a big group, so this is going to inform our understanding of commodities and stocks. And lastly, the rightmost group is the commodity producers. These are the companies that these are the mining companies that, for example, gold miners, coal miners. They are directly involved in the commodity business. Okay, so stocks and commodities are inversely correlated. This statement relies on the middle group, the consumers. Why is that the case? Well, it goes like this. So cheap raw materials means that those companies get to have higher margins. That means that usually they have higher stock prices. One example here is Kellogg's company. Kellogg's is, most people are familiar with Kellogg's. I'm assuming it's a cereal brand. I'm sure they have other businesses as well, but they're mostly known for their cereal business, breakfast cereals. And what are the commodities used in the cereal? Well, they need wheat, they need sugar, they need paper for the box. And so those are some commodities that this company needs. They buy these commodities in bulk, they put it together, box it, and then sell it to customers. So that's the value they add. They just put it together. And if these raw materials are cheap, it's good for this company. If it's expensive, it's bad for this company. They will have lower margins and lower stock prices overall. So this is the framework that we're looking at for the relationship between stocks and commodities. As commodities are cheaper, stocks are more expensive. As commodities are more expensive, stocks are more cheaper. Lastly, I just want to talk about these commodity producers, the rightmost group. So you might be thinking, okay, well, in a bull commodity market, these companies are going to be bullish as well. I mean, this is going to be a bullish environment for those companies as well, because they get to, if this is a gold miner, if the gold prices have been rising, well, they're going to make more profit. And so that's one way to play the bullish prices. But like I said earlier, it's better to get the exposure directly rather than through this company. If you think gold prices are going to keep rising, just buy the gold. Because if you're buying the commodity producer, then you have exposure to this idiosyncratic risks of this particular company and how it's operated. So it is often better to invest directly in the commodity rather than the commodity producer. Lastly, I want to talk about this very long-term view. So, stocks and commodities alternated 7 times for periods averaging about 18 years. So, what you're seeing here in this picture, in this graph, is US stock market relative to the commodity market. And on the y-axis here, we have the relative price strength. Stocks versus commodities, and it's on a log scale. So you can see that this is 1, this is 10, this is 100, so it's on a log scale. And on the x-axis we have the dates starting from 1871. This is a long view. It goes up to 2004. And the point here is this alternated relationship between stocks and commodities. It just supports what we've just discussed of this inverse relationship between them. So there are 7 of these periods, as you can see here. So this chart just shows that we should have a long-term view, and we should definitely have commodities in our portfolio in order to diversify. Let's focus on 1970s a little bit. So here, starting here, this period up to 80s. In this decade over here, this decade was great for commodities, but not. It's the opposite for stocks. During this period right here, sugar went up almost 12 times. Corn went up 3 times. Oil went up 15 times. Gold and silver went up 20 times in this decade. So this was a really good time for all the commodities. And like I said, the opposite for stocks. So we should definitely have some commodities in our portfolios to make sure that we're well diversified. This is a great book for commodities. If you're interested, you should definitely buy and read it. I highly recommend it.